Okay, I think we're going to begin. Welcome, everybody. Thank you for logging in. This morning's webinar is about commercial real estate debt and providing diversification opportunities during uncertain times. And certainly, if there's anything true as of today, we are living in uncertain times. Just a little bit about Zagga before we continue. We're very proud of our journey so far. We started in June 2017 when we launched our first loan. We've gone through a number of iterations of the business in getting there with a number of milestones. We're very proud when our AFSL and ACL was issued. The largest loan we've written to date is actually $31 million, but at the time was 29. We were pleased to welcome Japanese bank CRED Bank as an investor in November 2020. We launched our wealth fund in 2021 and were also given a superior investment grade rating by SQM. As we stand today, we've originated just about over $650 million worth of loans across 130 loans, and we've just closed out a $30 million corporate bond literally last week. So we're very, very happy with the progress so far. We've returned investors on average about 8.21% per annum. The average loan size across the business since we began is 3.175. That's actually about $7 million if you just measure it for this year. The average loan to value across all the loans on the platform is 62%, which is comfortably conservative, and the average loan term is around 10.6 months. So when you look at the Zagga story, our story really is one about being conservative, looking for value for our investors, but not taking any risks, and just trying to make sure that whatever you put in, you get out on time, in the right amount, and without any sleepless nights. Moving then to the next slide. Just a few words about what I'm going to say. Their investment decisions based on their own specific circumstances. I cannot really emphasize that enough. Everyone has their own set of circumstances. We can't and we don't want to be all things to all investors. We have a very specific product within a very unique niche. And if it works for you, that's fantastic. If it doesn't work for you, you shouldn't put it in your portfolio just because your friends are doing it. By the same story, if your friends are not doing it, that doesn't mean that this doesn't suit you. So please consider your circumstances when you look at these investments. We really cover two very obvious investment opportunities. One is versus direct investment, which means you go directly into the underlying loan as a direct investor, and you put your money directly into that loan via our lending trust. Alternatively, you come into one of our funds, which is a pooled investment fund, and you come in with a number of other investors into that fund, and that fund then invests directly in the underlying loan, and you have your share of that fund. Today, we're not going to talk about direct. If you're interested about direct, please let us know. And I probably should have said earlier, please use the chat button at the bottom of your screens or use the raise hand button if you want to ask any questions, and I'll be happy to answer your questions at the end of the webinar. So just to emphasize, direct versus pooled, we're not going to talk about direct today, but if you'd like to, please let us know. We're going to actually talk about pooled investments, and with that, we're going to move to the next slide. So just to define what is commercial real estate debt, I mean, this is now a term that's getting used, for many descriptions. It wasn't a term that was generally used a couple of years ago. It's becoming more popular, and all the assets, as opposed to say fund loan mortgages or something like that. So what is a commercial real estate debt for these purposes? Well, firstly, it's a loan, sometimes for a fixed return, not always for a fixed return, secured by a mortgage over commercial property. Our loans, when we write them in Zagga, are generally for a fixed return. The primary purpose of the commercial real estate debt loan is about improving or using that property asset. So it could be somebody buying property and land banking it. It could be somebody who wants to build on that property. It could be somebody just leveraging the property to buy some other assets or for some other business purpose. When we talk about the broader definition of commercial real estate, we're really talking about office building assets under construction or transition, i.e. from one form of construction to another, or from one form of use, such as residential, now being move to commercial or mixed use residential and commercial. And obviously building residential developments, whether they're high or low density, all fit into the commercial real estate description. And obviously what commercial real estate really does for the investor is it provides exposure to the property sector without the investor having to actually buy the property, or without the potential volatility of investing in a real estate investment trust on a stock exchange. So you can get exposure to the property sector via property funds or REITs, but this is a way to actually get direct exposure using a pooled investment to the property sector, almost by being a direct funder of the property through a trust structure. So you're not investing in a share, you're not investing in a real estate trust, but you're investing in a lending trust via a fund which has exposure to the sector. So hopefully I've been able to explain what commercial real estate debt is, but effectively it's the use of property, the financing of property for any purpose to get a return to the investor who's a funder of that property. And with that, we'll move to the next slide. So the interesting thing about commercial real estate debt, especially in Australia, and here we're just really tracking what's happening in the rest of the world, it's always been big business with a market, certainly for the banks, worth more than 305 billion, which is about an increase of $15 billion since December 2019. And that's probably last year's stat. I would imagine it's increased even more by then. But what's really happened is lots of private lenders have gotten into that market, really because the banks have been a little bit slow. The banks have also been a little bit uncertain. Sometimes they're in the market, sometimes they're not. Sometimes their rules are one thing, sometimes their rules are another thing. That has created an opportunity for private lenders, or what we really prefer to be called for non-bank lenders, to get into the commercial real estate debt market. And it's predicted that non-bank lenders will provide more than $50 billion worth of commercial real estate debt funding by 2024. Now, that's not so far away. So it's certainly a market that's here to stay. It's a market in which the non-bank lenders now have credibility. They certainly have a strong foothold, and they're going to grow from that foothold more and more and more as time goes by. But we'll move to the next slide. So one of the interesting things about the CRED market, and particularly about the private debt market, is that it's weathered COVID exceptionally well. If you just have a look here at this chart, you can see the private debt market in US dollars, billions of US dollars, over the last couple of years has grown literally threefold, from about 575 billion to 1.5 trillion over the last couple of years. And this is really because not only are there more non-bank lenders who are funding, but there are a lot more investors who now recognize commercial real estate debt or funding commercial real estate debt as a very conservative and reasonably COVID-proof and inflation-proof and non-volatile way of making a very good return on their money, especially for the money that would be otherwise sitting in the bank at very, very low interest rates. So just with that in mind, let's move to the next slide. Now, I guess what's important, if you want to look at commercial real estate debt, you really need to understand how the equity stack works, how the capital stack works. You need to understand where you exist in the chain when an investor, when a fund is looking for money. So let's say that I'm a developer and I'm looking for money. The piece that we as the funder put in is generally the senior debt piece. The senior debt piece has the lowest level of risk, but it's obviously the highest amount of debt. And because it's the lowest level of risk, because it is the highest amount of debt, it carries with it the greatest level of security. So normally, if you are the senior debt funder, you are the first mortgage holder on the property. Often, the senior debt limits are such that the borrower needs to supplement that with mezzanine debt. And the general term for that would be with a second mortgage. And the mezzanine debt is normally what comes in behind the senior debt as the mezzanine part of that, and that would be the second funders. Because the risk of mezzanine debt is slightly higher than the senior debt piece, then people involved in the mezzanine side would get a higher return than the senior debt, but by the same token, they don't have anything like the security. And then you get the shareholders themselves, and the shareholders could just be ordinary shareholders, the common equity piece, or they could have some kind of preference security. It could be a debenture, it could be a note. but effectively the equity is the last piece to come out. So if we were all lending to a developer and something should happen to that developer, the senior debt holders and the mortgage holders would first have a claim on all of the proceeds of the property until they were fully paid. And then it goes to the mezzanine debt holders, and then it goes to the equity holders. If there was, for some reason, not enough out of the proceeds of the property to pay the senior debt holders, then none of the other members in the capital stack would get paid. So the senior debt position is by far the strongest position to be in, and that's why we always like to take a senior debt position for Zagga loans. We're not equity holders in the loan, and we're not mezzanine or second mortgage holders in the loan. We're always the first mortgagee in the loan. We have the senior debt. Let's move to the next slide. So just to understand that, it's worth looking how corporate bonds have performed over the last couple of years. And the reason that this is interesting is because a corporate bond has always been considered to be a very conservative way of investing. This is really where you would invest in a loan instrument issued by a company, a large company. And what you can really see here is from a high in 2009, the corporate bond market has actually started to produce lower and lower and lower returns. There are many reasons for that. Certainly over the last couple of years, COVID would have been a reason. Secondly, would have just been global pressures on business markets generally. Thirdly, would have been the transition from traditional businesses to more online businesses. Fourthly, would have been just investors looking for better returns. Lastly, would have been the fact that very often corporate debt is linked to Reserve Bank kind of pricing. And as we know in Australia, the Reserve Bank cash rate has been incredibly low in the last couple of years. So if you're looking at a 3-year return on your money in a corporate bond, you'd have earned incredibly little. Whereas if you've had a look at the 3-year return on your money, as I showed you just 2 slides ago, in commercial real estate debt, you can see that the returns have been significantly better on the commercial real estate debt side than on the corporate bond side. Let's move to the next slide. And as I said earlier, the low interest rate environment has certainly been a factor in that. You can see how rates have come down. We're certainly seeing now some talk about an uptick in rates somewhere around 2023 or 2024, according to the Reserve Bank Australia. We really don't know what that is. The bond market has already begun to price that in. Bond rates have moved up by about 125 or 130 basis points over the last couple of weeks. Rates are moving up in that direction. The Reserve Bank, we know, is going to move rates. Some of the banks have already started to reprice their mortgage rates. But the fact of the matter is we still have a 10 basis point cash rate. And even if rates do go up, they're going to go up slowly and incrementally over a period of time. And, you know, even if those rates grow significantly, they're unlikely to get back to the 5 or 6% that we saw a few years ago. They're probably likely to get to 2.5%. That, by the way, is not an economist's prediction from me. That is just a personal view. There may be many, many others who have different views, so please don't take mine as gospel. But I think what we can all agree on is rates will go up. What we don't know is by how much. Let's go to the next slide. So then, just talking with all of that background in mind, we've spoken about the growth of commercial real estate debt as a product over the last couple of years, and it's tripling in popularity. We've spoken about the fact that the corporate bond market isn't getting the return that it used to give. We've spoken about the fact that rates have been exceptionally low, and while they're going to increase, they're not going to increase massively. So what's so attractive then about commercial real estate debt? And I guess the first thing is that it provides a middle ground between the traditional approaches of cash and bonds for safety and equities for risk. And this really comes from a piece of research we did in 2017, where we found out that the average personal investor, the average self-managed super fund trustee or individual non-advised investor really positioned their portfolio at 2 extreme ends. They either kept all their money in cash or in bonds, which gave the absolute lowest return, but gave the highest element of safety, or they punted equities on the market, which are highly risky, give very high returns, but the problem is you can never get the timing absolutely right. And in between the safety of cash and bonds and the relative risk of equities, there was a big middle ground which wasn't really populated. And we think that investing in commercial real estate debt more than adequately and actually very effectively populates this middle ground, because what it does for you is it helps you to diversify your portfolio risk. So you're not sitting either completely in safety or completely in risk, but you've actually got measured, controlled risk in the middle there, and you're also enhancing your portfolio returns. So while you may not be making the 12, 13, 14, 15, 16% that you think you can get for yourself from the equity market, you're also not earning the half or maybe 1% that you're getting at the bank, and you're getting somewhere in the middle. So not only are you actually putting your money to work there, but what you're also doing is you're also helping to protect and cushion your portfolio, either from getting too low returns on the one side, or from having some shock from where you're expecting your high returns. So it's very important to understand that we're not suggesting that you should not have cash or bonds or you shouldn't have equities. Not at all. We're suggesting that somewhere in your portfolio, a commercial real estate debt product helps to diversify that portfolio risk, and it's something you should consider. When you do that, you will see that returns from commercial real estate debt tend to remain stable during periods of crisis, especially during sustained economic uncertainty. And if you just take COVID over the last 2 years, and now may even become 3 years, whatever, you can certainly see that commercial real estate has been able to withstand that crisis exceptionally well. Investors have got good returns. They've taken very little risk. There've been very few failures, and they've been able to return for themselves predictable income streams at attractive interest rates. And as I said, it's demonstrated unbelievable resilience through the market cycle. And that's been aided and abetted by the fact that the banks really haven't been in the market. So borrowers have come around, and bank grade borrowers have come around, and they've turned to the non-bank sector in order to have their funding needs fulfilled. And that has continued to build and enhance the momentum of the commercial real estate sector. Let's move to the next slide. So moving now with all of that background in mind to our discretionary trusts. And as I said, if you're looking at a pooled investment, if you're looking at getting involved in commercial real estate debt, excuse me, and you're looking at populating that middle ground on your portfolio somewhere between the safety of cash and bonds on the one hand and equities and private equities on the other, then these investment trusts have actually been positioned to do just that for you. So we'll move to the next slide. Firstly, we operate a fractional lending structure. What does that mean? Just going to have a sip of my tea here because I've got something in my throat. It means that our investment structure is not limited, such as if you invested in a special purpose vehicle or if you invested in a unit trust, where very often your rights to the underlying loan are very limited. Effectively, you have a right to collect your interest and to collect your capital and not much more. Our fractional lending structure has got a lot more transparency and a lot more see-through, and in effect is a conduit to the underlying loan. So if you're sitting in one of our discretionary investment funds, that fund actually has direct access to the underlying loan. So the difference between you being directly invested or being in the fund is that in the fund you're pooled. What does that mean? It means your funds are held in a pool together with everyone else in that fund. And if that pool is $10 million and you have 1% or you have 1 million of the $10 million, then you effectively have 10% of that pool. If that pool is invested in 3 loans for $30 million, you have your 10% of each investment in each loan at your percentage, which means that you've got access to the underlying loan security, but it's in proportion to your share of the fund relative to its share of the underlying loan. That does a few things for you. Number one, it gives you diversity because you're not in a single loan. Number two, it spreads your risk. Number three, it gives you the opportunity to earn a return from a number of different underlying loans. And number four, you're earning interest all the time, because when one of those loans repays, there's still other loans going on. So your money is always invested all the time. In order to become an investor in one of our investment trusts, you must first be registered as an investor on the platform, which means you've got to give us your ID. We've got to do proof of identity. You've got to satisfy us that you're a sophisticated investor. But once you've done that, it's just as easy as signing a commitment letter and you're in the fund, and you can invest multiple entities in the fund. So you can invest in your own name, through your super fund, through your family trust, or whatever you want. And if you're invested in the fund, there's nothing to also stop you from investing directly on the platform if that's where you want to be. Moving then to the next slide. So what really is the difference between investing in the fund and investing directly? And I shouldn't really say difference, I should say what is the advantage of the fund over direct investment? So the first thing about the fund is if you put your money in tomorrow, whether the fund is invested in loans or not, you're going to earn interest from the day that you invest till the day that you come out. Whereas if you go into a direct loan, you only start to earn once the loan is successfully committed to the opportunity, and you earn interest for as long as you're in the loan. So if you have to wait 2 or 3 weeks to get in, your $100,000 is going to sit in the bank not earning very much. And then if you do get in, you're earning only for the term of that loan. If it's a 6 months loan, you're earning 6 months worth of interest. Whereas in the fund, if you put $100,000 in tomorrow, you're earning until you come out. As I said earlier, if you're invested in the fund, you're invested in multiple loans. So you have risk diversification. Whereas if you go directly, you're invested in a single loan, but you choose each loan that you wish to be invested in. In the fund, we choose the loans for you. If you invest in the fund, you don't lose out on getting into any loan. But if you go directly, it's first in, best dressed. And the reason we say that is our loans are pretty popular. We only put up one a week. They can often go literally in minutes, certainly within a few hours. So if your finger is not the fastest on the button to get into the direct loan, you got to wait the next week. Whereas if you come into the fund, you have no risk of losing out. The fund is always in the loan, certainly in all new loans, and you then get the benefit of being an investor and the diversification and the return. The fund earns exactly the same return as you earn in an individual loan. The only difference between the two is that the fund keeps a little bit of liquidity inside the fund to make sure that it can repay people when it needs to. And you have minimum periods in the fund which are different to the minimum terms of the loan. So depending on which fund you're in, you may have to be in there for 90 days plus 30 days notice, or for 1 year plus 90 days notice. Whereas if you're in a 15-month loan, you're in the loan for 15 months, or if you're in it for 6 months, you're in it for 6 months, and then you're remanaging your money at all times. In the fund, your distributions get paid 6 monthly. So every 6 months, you get the aggregate return of all of the loans in which your money has been invested, and you can keep reinvesting those dividends if you want to. Whereas if you're in a direct loan, the interest is paid per the terms of the loan. Some of that may be upfront, some of that may be at the end, some of that may be monthly or quarterly. And of course, once it's paid, it's paid. So the fund is a much more convenient, easy, effective, risk diversified way of putting your money to good use. But by the same token, as I said right at the outset, you should be deciding which way you want to go. Many of our investors are both direct and in the fund, but we encourage more and more of our investors to go into the fund because we just think it's a better product and a better outcome for them. We'll move to the next slide. As you can see, if you simply took an example of whether you were in our feeder fund versus direct loans, let's assume that we measured this over an 18-month window. Let's assume that you had a single $300,000 investment in the fund, and you had put $100,000 into 3 separate deals. One paying 7.2 over 6 months, one paying 7 over 12 months, one paying 7.5 over 9 months. What then happens if you actually have a look at your return, you'll see that the returns between the two are pretty similar. But what you don't see is how long it takes you to get into the fund and how long it takes you to reinvest your money. So from a risk perspective and a return perspective, you're really not prejudicing yourself in any way. But from a convenience perspective and from having continuity of return and getting an interest payment every 6 months, then the fund is probably the better way to go. Let's move to the next slide. So just as the funds appear right now, we have 2 funds. We have the Zagga Feeder Fund and the Zagga Wealth Fund. Each of them have a minimum investment of $100,000. The target return for the feeder fund is 6.5% per annum, and it's got a weighted average return across all loans invested in by the feeder fund. So effectively what happens is we gross up the return of all of the loans. We divide that by the number of investors, and that's how you get your return. If you're in the wealth fund is really just a proxy for your money in the bank. So if you've got money in the bank right now, it's earning somewhere between 1/4 and maybe 75, 0.75%. What we really pay you is we pay you 4% above the 12-month term deposit rate, and currently that's 50 basis points. So you're getting a 4.5% return, but your LVR average is at only 50%. So you're exposed, literally, you have the comfort of 2 times cover on the loan. If the property is worth $1 million, we're not lending more than $500,000 on that property for the purpose of your 50% LVR. Whereas in the feeder fund, that amount of the loan is $650,000 on the million. So it just comes down to conservatism. Obviously, the more conservative the fund, the lower the return. It's a bit like the capital stack I showed you. The slightly less conservative the fund, the slightly higher the return, hence the difference between the 2 funds. In the feeder fund, you have a lockup of 90 days. You cannot take your money out for 12 months, after which you can get it out after 90 days. So remember that, please. It's got a lockup of 12 months, and you then have 90 days liquidity, whereas in the wealth fund, you have a lockup of 3 months, and you get it out over 30 days. So again, people have the option of going into both funds. You don't have to go into one or the other. You could go to both. You could put money that you need, that's in the bank that you need quite soon, into the wealth fund, and you're going to get it back pretty quickly. And if you've got some lazy money and you want it to go to work for you, then you can lock it up for 12 months and get it from there. So those are really the 2 fund options. They both have worked extremely successfully up to now. We have a number of our investors who are both direct and in the fund, and we have a number of our investors who are in both the feeder fund and the wealth fund. But as I said at the beginning, it's really up to you to decide which is the best for you. Let's just move to the next one. So in conclusion then, it's really your choice. As I said, you can be invested in one or both, or directly, or a mixture of all of them if that's what you want. But I guess the bottom line is really this, and I guess this is the point I've been wanting to make. If you're looking right now at what you're earning on your cash in the bank, then this has got to be better than that. It's certainly going to be secure, because it's going to be secured by a property over which there is a first mortgage. Depending on which fund you're in, that mortgage is not going to extend beyond 50% or at most 65% of the value of the property. And depending on what fund you're in, you're going to get that money back either in 4 months' time or in a year and 3 months' time. So that's got to be a good outcome. I hope I've been able, during this short webinar, just to give you a sense of what commercial real estate debt is about, what the funds look like, and to perhaps create some food for thought for you as to whether this is a product that works for you, and if so, which or how many of those funds you would like to be invested in. And in that regard, please feel free to contact me or my colleagues. There'll be a slide shortly which shows you the contact details, and feel free just to talk to us about that. I've seen one question come up on screen, but as I said earlier, please feel free to use the Q&A button on your screen to ask that question. The question really was, how do we select the properties that we put into the loans? So it's a very good question. It wasn't really the subject matter of this webinar. That's why I didn't deal with it. But since the questions come up, let me answer that really quickly. We're very picky and choosy about the loans we look at. We probably only write 7% of the business that we see. So literally 9.3 out of 10 loans are turned away. It's not only the property that has to meet very strict specifications in terms of value, in terms of the nature of use, in terms of how we're going to be able to exit the transaction, but we also look carefully at the borrower and at the developer and the counterparties involved. And we also want to know what the nature of the transaction is. So right now, we're really not keen on funding boarding houses or hospitality assets. So it doesn't matter how good the property would be. If we're not happy with the long-term prospects of the business, we probably wouldn't get into those. We don't really go into high-rise apartments or low-end apartments because we're worried about that kind of apartment market. We have a credit team out there who's very, very experienced. They look at every transaction. We have external valuers that look at every transaction, and we do a thorough due diligence. We've now written 130, almost 140 of these transactions. and we believe ourselves to be skilled and very, very competent in being able to assess the quality of the asset and to make sure that when you invest in it, you invest in it with a high degree of confidence that you're going to earn your interest and get your capital back. I don't think I really want to say more about that now, but whoever asked the question, if you need more information, please feel free to get in touch with us directly, info@zagga.com.au. Or you can see here me and my colleagues, Jacob Nightingale, who looks after our private clients, Steve Levy, who's Director of Investments, and myself, Jacob@zagga.com.au, Stephen@zagga.com.au, Alan@zagga.com.au, or 1301 Zagga, or info@zagga.com.au. Just like to thank you for your time. I hope it's been a useful and informative webinar, and look forward to your support in the many months and years to come. Thank you, and take care out there.